your investments are most likely to go down. When the market goes down, everything goes down. We all know that investing is risky. Anytime you put $1 in the market, there is a chance that it will lose value. And in the recent market downturn, we've seen people's portfolios go down. So what is risk? Is this big, scary, unknown thing that you just have to live with in your investing? Or is there a way to understand it and actually reduce it? Turns out there are several types of risks that people track in the market and try to manage it. And the two most fundamental types of risk that every investor should know about are the systematic risk and the specific risk. So systematic risk, also known as the market risk, is the risk that things will go wrong in the big picture overall. That there will be war, there will be a pandemic, there will be an economic downturn or recession, there will be inflation. And regardless of how good of an investor you are and what type of companies you invest in, your investments are most likely to go down. When the market goes down, everything goes down. The good and the bad thing about the systematic risk is you can't really do much about it anyway. The only way you can avoid systematic risk is to stay out of the market, and that's probably not a good thing. The other type of risk is what we call specific risk or company risk. And that risk is related to the specific company that you're investing in. We call it specific because an opinion of a company and how it does is very objective. If the company is in the right or the wrong industry, if it has a good or bad management, if it has good products, good services, it gets its pricing right, it gets its marketing right. If it does everything right, it will probably rise. If it gets things wrong, the value and the price of its stock will drop. So here you have a lot more control. One thing you can do is just not invest in a company that you think has a lot of specific risk. But that's not easy. So the way you can take away specific risk is by what we call diversification. And in this context, it means investing in more than one company. Research shows that by the time you invest in about 40 stocks, you minimize specific risk and you are much more exposed to systematic risk. So when you invest for the long term in a good portfolio of securities, you're basically saying, you know what, okay, if some of my investments go up and some of them go down, and I don't make good choices about the specific companies that I invest in, overall, I know that my investments will do okay if the markets are good, if the economy is good, if there is low level of systematic risk or systematic concern in the markets. And that's the best way to be a long-term investor, where you have life goals, you have time, you have the capacity, you have the patience and the wisdom to invest in the markets, stay with them, and win over the long term.